Hey guys, hope everything is going well. You guys know that drill. Smash that like button, subscribe if you haven't, and comment down below. Follow me on Instagram at AIH_sports. In addition, follow me on my finance channel on YouTube at AIH Finance, where I talk about a whole bunch of factors going on in the economy. And I don't talk about sports cards there. This is mainly the sports card channel, but I tie in finance topics. Now, also, if you have any topics that you want me to cover, put them down below. I'll see if I can do them. I have a bunch of topics just I've written down on my phone, and hopefully I'll get to some of your topics. Now, I wanted to do this video, and it's a response to the great Curator over on YouTube. I've seen some of his YouTube videos, and here are a few things. Before I get into this response, I want to say that I do believe he is a sincere individual. You could tell he's a smart guy, he's a lawyer, he's well spoken, etc. Now, he talks about Josh and he talks about his paper. We know Josh, the guy that created that created StockX and now is leading Fanatics, the trading division or sports card division. And he talked about his paper about how Josh believes a few things uh, regarding whether the market is healthy. That was his title. And in that paper, though, Josh was talking about three main components. You need to know about the people, the price, and the company, I believe. And regardless of whatever those three topics were, I believe that Josh doesn't understand, and a lot of smart people in this hobby, they do not understand the basics of the collectibles market and the sports card market. For the market to go up, obviously, this is a common sense thing. It's supply and demand. So if you have little supply and excess demand, like you did last year, the price of sports cards is going to go up. I think everyone can agree upon that. And then there could be various factors that affect the supply, that affect the demand. For instance, what affected the supply was PSA shutting down, that decreased the supply. But then what ended up happening also on the other end was you drastically decreased the demand in sports cards because there was no arbitrage opportunities at PSA, at BGS, and then SGC was the only one that was open. Now, they were the third best grading company out there, so the arbitrage game wasn't as strong as it was if you had PSA open. And still, the backlog is over 5 million cards from my understanding. Correct me if I'm wrong. So you have various aspects affecting supply and demand. But what a lot of people don't understand is that the Federal Reserve plays a huge part in this. And yes, they do because it depends on interest rates. It doesn't matter how high or how low interest rates are, it depends on positive interest rates versus negative interest rates. And I've stated this numerous times. And a lot of these so called experts that the hobby determines, they don't get this. And eventually, interest rates are going to go substantially higher. When you have these higher interest rates, what you'll have are positive interest rates. In a positive interest rate environment, well, guess what? That isn't suitable for many sports cards. Yes, you will have some sports cards go up, such as a player that exceeds expectations. But if you're looking for the big run up like you had last year, you're not going to see that. And we've enjoyed the last few years of negative interest rates, which has made sports cards go up like crazy. And yes, you had stimulus checks. Yes, you had the Federal Reserve uh, injecting over $120 billion of liquidity since June of 2020, and that ended in the winter of last year. Now we're in a new paradigm where it's going to be a much more difficult environment. Now, some people are benefiting from Marvel cards that they bought. Okay, there's a rotation of capital. But all these sports cards, I was talking about this in my video. I did this this morning. I'm going to publish this video tomorrow. And that is that the Fleer 86 Jordan card went from $720,000 to what? What is it right now? $240,000 based on card ladder. So the prices have gone down significantly. And all I'm trying to say is that a lot of these experts, they don't understand the basics. And when you do that, I think that's going to lead many people into trying to find who the next Guruji is, or who the next pundit is, or who the next Nostradamus is, in terms of who is the so-called expert in terms of all of the aspects in this hobby. And that's why I tell people, read older books on collectibles and what made it go higher. And now, regarding the aspect of whether this market was healthy or not, from my understanding, I believe that the great curator was saying that it isn't as bad as what some people are saying. Maybe people like me, that the market isn't completely unhealthy, or the market is somewhat normal. Not somewhat normal, but isn't as dire as many people are saying. And I do believe the market is unhealthy, and I'll tell you why. Number one, we've had a market that was based on funny money and all this government cheese. That made the market go ballistic, and yes, we were stuck at home. And because of that, you have to get rid of these individuals who are just in it for the quick buck. The shoe flipper. And speaking of shoe flipper, Josh is a shoe flipper, okay? Josh is an individual who made a great company, StockX, and now he's coming into sports cards. And now he created this, I believe, in 2015. He created it at the correct opportunity when people his age were getting back into collectibles. And also, interest rates were artificially low, and it just, his idea was perfect for that time frame, because people his age started to make good money and they could speculate in shoes. And that idea came over to the sports card market, and the sports card market happened to benefit from this pandemic where we were all stuck at home and you had all this money sloshing around. It made sports cards go ballistic. And now we are getting out of this pandemic, and I'm going to do a video pre-pandemic versus post-pandemic in the coming weeks. And long story short, we're coming out of it and things will get normal. Remember what happened last year? The economy opened up in what, March here in Chicagoland, because everything was still shut down, and people started to buy less sports cards. There was a run up when people came to Chicagoland or Rosemont for the convention, but it was a gradual decrease to the downside. What's going to happen now when now you don't even have to wear a mask regardless in the coming weeks? What's going to happen when people who saved up all this money are going to go on vacation? Now weddings are going to happen. And yeah, weddings happened last year, but still, you're going to have a lot more people do the things that they did back in 2019. And people are not going to be as worried about the virus. So what's going to happen? What's going to happen to the sports card market? Especially when a time when they are raising interest rates. You have to remember, when you have interest rates too low for too long, the Hayek principle, where he won a Nobel Prize, you start to unwind all of this nonsense from the economy, all of this funny money. Guess what? The bubble is going to burst. Well, guess what? The bubble already burst last year. Just imagine when we go right now from a negative interest rate environment where the 10-year tips is what? At negative 50 basis points, close to there. And the 5-year tips is negative what? 90 basis point, something like that. What happens when that negative turns to a positive? Like I've stated before, positive interest rates are not bullish for many cards. Some cards, like I said, will go up without a shadow of a doubt. So we're going into that environment where we're going to see probably more bankruptcies, in my opinion. Not tomorrow, but in the coming years, we're going to see more scammers get exposed. We're going to see probably more middleman issues, like we saw with Karl Marx. And we're seeing all of these issues happening. And in my opinion, for this market to be healthy, you need to see more pain. And you have to go back to the 1990s to see what happened at that moment. You saw interest rates spike. You saw a bunch of these places close down. We haven't seen a bunch of these shops that opened up close down yet. So once you start to see that, once you start to see more of the pumpers leave YouTube, get frustrated, don't do videos, and you're starting to see some of that right now. You're starting to see a sentiment change. So do I believe the market is healthy? No, I do not. In order for this market to be healthy, you need to see more pain. You need to see more people give up in this market. And once this great reset happens, for the next few years, in my opinion, we'll have more of a normalized market and it will be healthier. I think what will propel this market and the next cycle is probably they're going to give more funding money. It's probably going to be something like UBI or more stimulus checks. But those are my thoughts. I know he may disagree with me on this video, but these are just my own thoughts. All right, guys, let me know what you think. Smash that like button, and I'll talk to you later, guys. Thanks. Bye.